All right. So there's a few things I want to talk about today, and one of them, well, two of them. One, I want to really talk about strategies and performance and some research I've done. And the second thing is I've put together some models, and I want to show you the models I put together and talk about how I'm using them and kind of where we can go from there. So let me share my screen here. I just got to get this over here. All right. Are you guys seeing an Excel spreadsheet here? Somebody give me a heads up. All right. So one thing I wanted to do is I wanted to try to, I've been very kind of confident in these Fidelity Z models and blending in some of the index funds that we've talked about, and we'll talk about that more here in a bit when I get into my models. But one thing I'm doing, there's kind of three tranches of clients I'm putting on to FMAX. So my first priority is new money, just new clients, new activity, all that kind of stuff. My second priority is, as a feeder, when I have time, I'm contacting people on Betterment and getting them moved over. And then my third priority, that at this point is going to be kind of as I'm doing annual reviews, I'm going to start pivoting people from Goldman Sachs over to FMAX. And so the first two go without saying, but I wanted to understand, like, I know FMAX fees are a little bit better than Goldman, and I think the performance is better, but is it actually? And I wanted to really spend some time on kind of what strategies are doing and comparing and contrasting. So the easiest way I found to do it was what I'm showing you here. This is a spreadsheet that I put together over the last couple of days. And it's really tough to compare Fidelity and Goldman Sachs because they report so differently. Goldman Sachs doesn't produce like rolling period returns, like 1 year, 3 year, 5 years. So you can't always see that. TFA no longer produces composite returns, which they used to because they've turned off the platform. So the only way I could really do it was to go into live accounts and just manually do time periods 1 year at a time. So what I can't do is compare like 1 year, 3 year, 5 year, but I can compare calendar year by calendar year. So basically that's what led me to this format right here. And just starting at the top, what I've done is I've looked at the last 5 years, basically including year to date this year. These are all gross returns. So all of this is before fees, which is just the easiest way of comparing things. And then you can net out fees, on your own. But the first thing I want to do is I wanted to kind of compare a few different things. And this will allow me to draw some details from this I can share with you guys. So all the Fidelity strategies are in green. All the I-series strategies are in this like kind of peach color. And then I have some Vanguard in here. I kind of ran out of time to go all the way down with Vanguard. But I wanted to see, first of all, before we talk about Fidelity, the closest comp to I-series is the Vanguard portfolios because they're primarily using Vanguard funds in them. Now you'll see there's going to be some differences in performances based on just different allocations and all of that. And I-series also use some BlackRock ETFs called iShares and a few other things. But I find it interesting that I-series has been, I guess, solid, but it's been the only game in town. But I think Vanguard is slightly better than I-series based on performance. If you look at I-series was better in 2021 than Vanguard. The Fidelity 100% model didn't have a full year of 2021. That's why I put not applicable. But Vanguard has beaten I-series in every other year by a decent amount. 1 to 2% a year compounded over time is enormous. And so then when you look at the difference between Vanguard and Fidelity, you'll see that Fidelity is pretty much edging Vanguard every year. Some years by less than 1%, some years by yet again another 1.5%. But when you look at that, zoom out, the step up from I-series to Fidelity Z models is pretty massive. I mean, I think I'm comfortable with somewhere between 2 and 3% per year return differential. Now, some of that is because of Fidelity's a little heavier weighted towards US than I-Series aggressive is. There's a slight difference there, and US has been really strong. Some of that is that Fidelity is a little so I-Series has always been a little value tilted, not a ton, but they've just been a little more on the value side of things, which has just been an underperforming kind of factor. And then the last piece of that is going to be Fidelity's active management piece of it. So, those three things also explain the difference between Fidelity Z and the Vanguard 100 portfolios. So I just love the Fidelity Z models. In fact, I would tell you, I'd have to see Fidelity underperform Vanguard for probably several years in a row before I would start reevaluating that, because they've already demonstrated such consistent outperformance. And I like the pricing that we get because you get the platform fee discount, which we've talked about. So I just think we have a really awesome vehicle in these Fidelity Z models. And if you go down to the kind of moderate growth category, you'll see kind of the same thing. We're 1 or 2% better across the board compared to Vanguard and I-Series. It's not apples to apples. Vanguard has an 80% stock and a 90%, where I-Series and Fidelity are closer to 85, 86. Anyway, I'll share this. I'll send this out via email or I'll post it on the Facebook group. I'll get it out there somehow. But I thought this was pretty revealing. Any initial thoughts or questions on what I'm showing you here? I know it's kind of a lot to set your eyes on, but as we roll down here, even going down to like kind of the moderate category, which is anywhere between 50 and 70% stocks, probably, again, you're seeing really consistent outperformance from Fidelity over Vanguard, over I-Series. If you notice, like, for instance, look at, well, not quite, but I mean, Fidelity's 50% stock model isn't that far off from Vanguard's 70% stock model, which is really saying something. The last couple of years, there's a big gap here in 2023. But anyway, I just think those guys are really nailing it. So the other thing I wanted to show you guys was all the way down to this Fidelity bond index. So if you look at this bond index, I mean, you guys, this is the story of the bond market the last 5 years. So an okay year this year, pretty much nothing last year, an okay year in 2023, a disaster in 2022, and it started slipping a little bit in 2021. So bonds have been dead money for 5 years. And one big thing I want to share with you guys, I mean, we've kind of talked about this, but bonds are, if you look at the difference between like a 40-60 portfolio and an 85-15 portfolio and 100%, like basically the entire story is bonds. The bond allocation on asset allocation portfolios has just been a dead anchor weight to performance. And that really is all you need to know about the fixed income market. The reason 2022 was so terrible was because interest rates were rising so aggressively, bond prices, commensurately fell. But what's interesting is a lot of people, if you asked 100 people on the street, hey, is a 100% bond portfolio more conservative than like a 50% bond portfolio and a 50% stock portfolio? I think 99 or 100 people would say, well, all bonds would be more conservative. I mean, would you guys agree with that? But yet, look at the loss. You lost 13% in this portfolio, which is pretty much on par with a 40, 50, 60% stock allocation. And yet the returns on the upside are so much greater. So there is this thing called the efficient frontier. Have you guys ever heard of that? Mm-hmm. So it's kind of this like fishhook looking thing. I could Google it and show you guys, but essentially what it comes down to is there's no the efficient frontier is a measurement of risk and return at different allocations. And whatever time period you select will give you a different answer. But as a general rule, like a 30 or 40% stock allocation is generally considered more conservative than 100% bond allocation. Like 30% stocks, 70% bonds, because you have that diversification there. You don't have all that interest rate risk. So as an example, I don't think I'd ever use this 20% or 10%, let alone this bond index. I just put these on there for you guys to kind of see. But I find that stuff really interesting, and I'm bringing this up because when I get into the models, I'm going to show you, I'm going to kind of show you the models, and then I'm going to show you how I'm explaining them, and some real talking points on, picking up money and convincing people to make some moves here. But then as you look down here, I put the mutual fund returns here. So the S&P 500 returns, the Fidelity large cap growth that I like using. And obviously we know 2022 was a really painful year. But the most I have any client is 20% in this. And many are less than that. But, look at U.S. strategic growth. This has been a heavy allocation for me. So my Goldman accounts have done okay the last 5 years, fortunately, because of this U.S. strategic growth. But even when I look at, 2024 performance, it's lagging these other indexes. And the reason is because it has a little bit of small mid cap in it. It's 15% of the portfolio. And so small mid cap stocks have just done almost nothing in the last 5 years. But look at year to date this year, it's actually outperforming both of these by a hair, only because small cap is finally doing something this year. So those are just kind of some moves in the market. I'll send this out so you guys can kind of look at this, use it as a reference. All of this is through August. But I think it's really informative on, this just even boosted my confidence that much more on, the model construction we're using, the platform. And then on top of that, obviously you got the fee difference here. And so I just kind of put this on here just so you guys can see kind of apples to apples. But, if you keep your rep fee the same, you're at 1.7% out the door on Goldman. So that's essentially 50 basis point platform fee. You got about 10 basis points for the expense ratio of the ETFs. And then your 1.1 fee, you're at 1.7. And if you do the same thing on Fidelity, you're about 1.45. Now there's a variable here, which is this platform fee. So depending on how much of that Z model you're using, you could have a platform fee of somewhere between 3 and 6 basis points. It will move a little bit based on how much credit you get, but obviously it starts at 15. And so, now your ETF expense ratio is a bit higher on that Z model, but when you blend all of it together, you're about 25 basis points cheaper. So what I'm doing for my clients is I have that fee schedule we talked about where I'm starting at 1.25 on the first 150,000. And then I go to 1.1 and then 1 and then 0.9 all the way down. And so my larger accounts, even accounts at 300 and 400,000, the fee difference is not much more. But that's giving me a little extra profitability on small accounts, which take just as much work. It's a little boost for moving the accounts, and I'm still lowering fees to my clients. So I'm lowering fees to my client, and I'm really upgrading the performance and the experience there. And I'm upgrading my ability to manage this, which we'll get into with models. So it's just a huge home run. And so this just freed me up to just be that much more aggressive with, getting with clients as I find time to be like, hey, I think we need to make a move here. And anyway, I know I just gave a lot of information out, but is that kind of making sense to you guys?
This is really helpful. Thanks for putting this together.
Thanks, man. Trying to earn my keep around here. By the way, as you guys are building a recurring income model, keep in mind, if your clients are earning an extra 2% a year, that your whole book of business is compounding at that much more, right? And so I'll be honest, I kind of wish I had this 5 years ago, because maybe I'd have an extra 5 or 7 million under management than I do today. But I'm sure glad I have it now, right? And so, you guys can move a little bit quicker than me with, less accounts to move. But if I were you, I would be very aggressive at getting stuff moved over. And I think I just told Alec this, but you know, because I do think the day will come where we sunset Goldman like we're sunsetting Betterment. Um, that's not the plan. There's a commitment from both TFA and Goldman to reevaluate that platform at the end of next year, and so we're good well into 2027, because even if one party or the other basically say, hey, this, and it would probably be Goldman. If Goldman says, hey, you guys have moved a lot of money away from this, at this point, it's not worth it to us to service it. They're going to give us, 3, 6, 9 months, whatever it is. So I think you got probably 2 years, but in my view, I'm not serving my clients by just letting them hang out on Goldman. I think it will take me close to 2 years to get everything moved, frankly, because, some people you just can't get a hold of and all that kind of stuff. But I'm going to do as much as I can the next 6 months just to front load it and just rip the Band-Aid off and go. And anyway, and I'm going to give myself a slight pay increase on that, and then I can obviously scale the business a bunch more. So the last thing I want to share is at the bottom here. So really from a legacy standpoint, because a lot of people like the Calamos funds, including me, they brought them over as mutual funds on this platform, and so they are expensive. So, if you're using Calamos, or even Congress, in fact, I think I've got Congress written on here, all of those SMAs on Goldman had an extra 40 basis point cost. Fidelity's a similar arrangement. There's an extra cost there. But for a lot of my clients, for years, I used Summit Global, and then that got replaced by Goldman. And so I have tons and tons of accounts that have, 20, 30% of the portfolio in Congress. And so, I'm gonna save those clients a lot in fees by just moving over to kind of more of a core allocation. So I feel great about that. So let me stop this. I'll send this out, like I said, and then let me pull up. Let's see here. All right. So what I did is I went in and I've created some advisor models here. Now, a mistake I've made is I was thinking that I was going to wait a bit to put my models together until the company added all their other funds they're going to add on this enhanced program, which, by the way, all of you guys have that enhanced program now, I believe. But then I just kind of had an epiphany one day. I'm like, that's really a stupid decision, because I don't expect I'm going to use most of those funds, because most of them are going to be actively managed mutual funds. I think there might be a couple that are interesting. But the more accounts I set up that aren't in models, I've got to go and obviously put them into models. And so I'm creating more work for myself. And I just got so stuck on that. So this is an idea where I don't always know all the right answers. I had this epiphany one day. I'm like, wait a minute. Like, the whole point of a model is if I want to change a model for any reason, I make one change and then it updates all of my client accounts. And so if something comes out in 3 or 4 months and I want to add a new fund to it, then I'm just going to add that, and it automatically updates all my accounts. So that's on me. I would recommend you guys build models just like me as soon as possible. They're working on sharing capacity. They're going to beta test it with our group, where basically, we can create models and share them with each other, or at a minimum, I can share it with you guys. It's not live yet, but that said, you guys could manually, I'll get this out to you guys. You guys could build all this in under an hour. And you guys don't have to use my model, by the way. I don't get a kickback. There's no ego involved. If you want to do something different, I'm totally good with it. I'm just going to tell you what I'm doing, and you guys can take it for what you want. And so for now, I'm using 5 models that correspond with the 5, risk tolerance tiers on FMAX, which are pretty much the 5 there is anywhere, anyways. And then I may not put every single client in one of these models, but most of my accounts are going to go into one of these models. And because I might need to do a little customization based on certain situations. But I'll take you through kind of what I've done. So I just like if I start with aggressive, I go in there and this is the model I've built. And again, all of these are subject to change, but I'm using 60% that Z portfolio, all stocks, and then large cap growth and Fidelity 500. And I just like how that allocation kind of looks. I'm 80% US, 18% international, and that performance. This performance. If I were to kind of manually come up with this performance over the last 5 years, I could do it on that Excel sheet. I mean, it would be pretty incredible. So, it's not going to guarantee outperformance always, but I really like this model. And frankly, I like how there's some limitations on this platform that save me from myself because I'm just as subject to getting a little too eager and greedy in bull markets as I am getting a little too conservative in bear markets, as we all are. And if it were up to me, there might be some days where I'm like, well, I don't need international at all. But this is a good year that proves that value. And I do think there's a diversification element you pick up. And so, the fact that I can't do more than 40% in direct funds, I think it's a healthy guardrail to make sure we're building really diversified portfolios. So, and there's a couple of things I'm thinking when I build models, and you'll see this when you play with this. But if you start blending more than one FSP in there, which you can, what's going to happen is your minimum investment is going to increase. And so you'll end up with, you have a model that you have to have, let's say, $40,000 to get into it. And that's just not going to work from a practice management standpoint. So that's another factor I wanted to mitigate. Ryan, I think you had a question yesterday about drift. Did you want to ask that question?
I mean, mainly just because it's a new parameter that we're setting relative to, a Goldman account. So I know what it is. It's just
Okay.
understanding, it's what's, I guess maybe the question is, and this might be nuanced, but, setting it at 0.5% versus 3, like what does that trigger difference look like in real life?
Well, I don't know if I have a precise answer other than to say I wouldn't do a half because you want to allow funds to do what they're going to do a little bit, right? So because if you do a half, basically you're just going to trigger that many more rebalances every time. Let's say large cap growth keeps running, right? I mean, you're just going to have a rebalance every month as it outperforms your other holdings in a bull market. And in a taxable account, that's that many more transactions. So, John Fonash told me to back in the beginning, and I that seems about right. Because if it's a 20% allocation, a 2% drift, I mean it's got to really outperform a lot before that 20% becomes 22, and then beyond 22. So you could probably argue for 3% even. But I do think this is part of portfolio management, especially for more conservative, moderate clients, where they don't end up with too much equities, and then all of a sudden a bear market comes and they have a bigger drawdown than they expected.
So I guess the follow-on question is, it sounds like it matters more for non-qualified money.
Yeah, because like on a qualified account, the transactions in a sense don't matter because there's no tax consequence to that. But I still would want large cap to run a little bit before I'm constantly like taking profits, every week, couple weeks, or every month or so. And I don't know if I have data to back that up. That's just kind of a gut feeling of where I'm at.
Mhm.
So that's kind of my aggressive model. my moderate aggressive model. And if you look at, I think it'll show me on this page. Here we go. So it'll show every model, like what risk score you're at. And you'll notice that all of my models, so again, my preference is I'm a little towards the upper end of each range because I just think over time, you're just going to pick up more return over time. I mean, that's kind of an undisputed, law of investment management. But, I've got the 70-30 model, and then I'm just using a little bit large cap growth and S&P 500, but I kind of just did a little bit less growth exposure just to tamp down that risk a little bit. If you play with this a little bit, you'll notice that will, like if I went 20 and 20, I think I'd be right up against this line probably. So that's where I'm kind of at there. But I think what I want to do as I get into moderate, I'll show you something I've changed that I could have done at Goldman. I just never did because I've got access to so much more data at my fingertips. It's helping me see things a little differently. So one of my pitches to moderate, so you'll see the holding here. I'm using Calamos hedged equity, which I really haven't used at all, even though it's been available all this time. Now, what I don't love about this is its cost. If I don't want to click this and get off the screen for a minute, but the cost is definitely going to be higher on this. So I want to come back to that. But essentially what I'm doing is I want to come in, and I think from a marketing standpoint, sometimes you need a little sizzle, you need to sell a little something to differentiate yourself from, well, why don't I just leave it in my target date fund, or why can't I just do this on E-Trade or whatever? And so I think by using Calamos hedged equity, first of all, it just sounds pretty fancy, right? We're hedging risk. This is a customized, strategy that you just can't buy retail. But then I'll talk clients who I want to overweight US over international. I want to overweight growth over value. Those are two talking points I'm always using. But then I'm also talking about constantly, hey, one of the ways I've added the most value to clients is by, getting them a little bit more comfortable with equities versus so much in fixed income. One of the biggest mistakes clients make is they have way too much money in bonds for most of their life. And everything from target date funds to let alone they get closer to retirement and they start doing balanced funds, all this stuff. And that bond exposure is such an anchor to performance. And frankly, it doesn't really give you anything from a risk mitigation standpoint, as I just showed you. We're going to dive into research tab here in a sec. But the beauty of Calamos hedged equity is I'm getting the volatility buffer that I basically am wanting to accomplish with some fixed income without using fixed income. And so instead of like a 60% stock, 40% bond portfolio, or even 65-35, when you look down here, I'm coming in at like 65, 66. So I'm basically 2/3 stocks, but I'm only 17% in bonds. And then I have this alternative exposure. And I think from a marketing standpoint, that just gives you a lot of traction on differentiation and using language like I'm custom building portfolios, and we have access to institutional strategies that most retail investors can't access. I mean, those talking points are worth their weights in gold. I mean, I just can't tell you the traction I get with those. So does that make sense to you guys? Any questions on this? So
what does that investor fee look like on this model?
I'd have to go to a different tab and show you, which I will. But notice I'm just noticing I'm actually outside of moderate a little bit here. But I think the system gives you like just a bit of tolerance. Like I think you can go 3% outside of it if I think I was playing with this. So I might even play with this a little bit more. This is where it is currently. I wanted to get a little bit of large cap growth in there, but anyway, I could change that. In fact, just to show you guys, if I edited this, and let's say I did 5% large cap growth and 18% S&P, Save. Now I'm still at 63. Maybe it weights S&P and growth the same. It's 23. So if I did, oh, that's draft target. That's why. Yeah, that's that bumped it down to 62. If you so yeah, you guys can play with this a little bit, but um I just think it's pretty cool. Let me go back in here and just show you then manage advisor models. And then if I go to conservative or moderate conservative is my next one. I got this one down kind of where it needs to be. But similar story. I'm using Calamos hedged equity. I'm blending in a little bit of market neutral income, which is even more conservative, and I'm just using Fidelity's model. And by the way, I'm going to go to research tab here next, but I spent a lot of time on looking at I think I had the opinion a couple weeks ago that on conservative models, like American funds was looking pretty good, and they do, but apples to apples, Fidelity is right there with them, if not a little bit better. And the pricing is just a lot cheaper. And so I'm just going to stick with the Fidelity Z models. It's just a lot simpler process. Plus my minimums are stay low. So that's kind of my moderate conservative, and then my conservative, and this would be kind of this would be a good transition. So for your clients that if you have cash management clients at Betterment, which I've inherited some, but I didn't have any organic to me, this would be a great cash management alternative. This is super conservative. I mean, this is 20% hedged equity, 20% market neutral income, and then the 2080 model. I don't even know. I would probably talk clients, frankly, to do the moderate conservative over conservative. But hypothetically, if I had a super conservative client, you can see where this is on the risk standpoint. I mean, I'm like 12% in stocks. I'm close to half in bonds, and then I got all this alternatives in there. I mean, this is a very consistent performing portfolio. But let me just show you. I'm going to bounce over to research real quick. And
While you're doing that, I met with someone last week. She had about 18 grand in a CD that matured and was walking her through kind of this research tab here and was showing her the different Z models and was just showing her, hey, we can do a pure bond alternate and here's the historical returns. And before I knew it, we were able to walk her up to a 50-50, the 50-50 model, putting some of her money into that, and then the Calamos market neutral because she just saw, hey, for an extra 10% in equities, I'm getting like 3 to 4% a year annualized returns. I would be dumb not to do that, especially if I don't truly need this money anytime soon. So it was pretty easy to walk someone through who's probably more conservative and show them the cost of being too conservative.
and if you think about it, guys, for so many years, I thought I'd have to have some magical money manager to justify a client having me manage their money and paying fees that they otherwise wouldn't have to pay. And I just was so off base in that, right? My value. I mean, Alec, what you did to add value to that client in terms of getting her more comfortable with more equity exposure, I mean, that's worth its weight in gold. That's worth many times what she'll pay you in fees, let alone all the service she's going to get. And and I think the more confident you are at communicating that, you just don't have to have this magical story to convince somebody to invest money with you. What they want is service, advice, and a process. And what was I going to say? Anyway, yeah, I lost my train of thought there, but I just think that's what I was going to say. I'm tripling down on this idea. In fact, I've even said this to a couple clients when I cover the fees. Is I go to the fee tab and I walk people through the fees, and I don't pussyfoot around with it. I'm like, hey, this is my fee for all the work I do, and just so you know, I mean, a lot of that's the financial planning that we've done and will continue to do over time. A lot of that's me keeping an eye on these portfolios, making adjustments when necessary, communicating with you. But part of that value is you have me. Like you've got my cell phone number. You can come in here and meet face to face at any time. I'm not going to charge you for that appointment or that time. And I don't know about you, Jeff, but every time I'm calling something now for a service related item, I got to get through like a web of bots and AI algorithms just to get to a human being. And like I just that is such a connecting kind of like shared experience with people where they're like, oh my gosh, you're right. And I'm like, aren't you glad on your money, some of the most important assets in your life, that you've got like a co-pilot, on your speed dial at any point? And that's something that you could either just like take for granted or not cover at all. And frankly, I haven't covered that at all up until a few months ago. I mean, how do you quantify what's that worth, right? I mean, I think that's worth a ton. And so anyway, let me get into this research and just show you just a little comparison contrasting. This is a change I've made by looking at some of this. But if you look down here at, for instance, in fact, let me go to conservative. So if you start looking at some of these like 20% stock, 10% stock, or all bond allocations, you can look how low these returns are getting down here at 3 and 5 year returns, right? Almost nothing. And remember, these are gross returns before any fees. So just doing nothing. But then look over here at max drawdown. Even the preservation models are at 7%, 6% drawdown. Most of the bond models are 15, 16% drawdowns. Okay. So then you come down here and you look at mutual funds, and let's find this Calamos hedged equity. Max drawdown 16. So we're a bit outside those bond drawdowns, but not by much. But look at the returns. I mean, massive. So your clients is so much farther ahead. So back to this idea of, even though the fees are a little bit higher, if I click on this, Ryan, and go to composition, 90 basis points in fees. I mean, it's just expensive. We're tacking on an iShare mutual fund on top of an investment platform, but it's only 15 or 20% of a portfolio, right? So it's not going to destroy you. But the alternative is that much more in bonds that just aren't going to earn that much return. So to me, like, the risk adjusted return impact of adding that hedged equity strategy is incredible. And then the impact on your ability to create some real, distinction and differentiation over, well, why can't I just leave my money in my 401k, or why are you better than Joe Blow at Edward Jones or whatever? I just think it's really compelling. And then I say the same thing about market neutral income. What it's returned relative to bonds is 3 or 4% more per year the last 3 to 5 years, maybe 3%, and its drawdown is less than bonds. So anyways, I just think we have the ability to really add a ton of value. To me, this is what we're seeing here, you guys. I'm telling you, I've asked for this. I've asked for a lesser version of this for like 10 years. This is better than I expected. And I've been through so many pilots and so many things that never got off the ground over the last 5 or 6 years. I mean, we were going to do this platform with Schwab back before COVID. And, COVID just kind of killed that essentially. And then they did FMAX and it wasn't done correctly. And now they've fixed it. I mean, I'm telling you, this is the gold standard in the industry. There's not anybody out there that has a better platform in terms of managers, pricing, technology, user experience, branding, all of that. It's there. And frankly, um, there's other, this enhanced platform is going to come out. It's going to give us a little bit more versatility, but more isn't always better. I almost like that, I don't have to sift through 1,000 strategies to find, you know, like they've given me a pretty streamlined, even if you use the Vanguard portfolio, you're all right. But I just think the Z models are the way to go. So, anyways, all of this kind of spending time on research in return versus risk. Guys, I don't even know what a Sharpe ratio is. I mean, I've read it probably 10 times in my life. I couldn't recite it to you. Who the F cares? Like, the only thing people want to know is how much can I lose? Like, I just think max drawdown is the easiest thing to understand. And if you have a really technical client, I mean, just to show, like for instance, let me show this to you. Like, you click this and you go to performance, and then you go to detail. You can get counter your performance monthly. I mean, my gosh, but look at this tab right here, drawdown analysis. Boom. Hey, what's max drawdown? Well, let me show you what it is. You guys, I'm telling you right now, if you want to get really great at picking up money, just put some practice in this. But when, I did this on my TV in my office. I mean, guys, this is an unfair fight. People walk into this gorgeous office. There's credibility everywhere. We're sitting down, technology, they see right on the screen. And my ability to just very casually click through and at my fingertips show them things like this, it's just like, I mean, it's mind blowing. Like, people are like, wow, that's pretty cool. Like, and just almost without having to say it, what I'm communicating is through me, you have access to like the best stuff in the whole investment world. And without me, you're totally on your own. Good luck. Like, it's not a fair fight. We're going to pick up money way more often than we aren't. Not every time, because relationship still matters. Other dynamics will still come into play. But anyways, you guys get good at this. And I think we're on the front end of the gold rush. It's the absolute gold rush for assets right now. And, the more we get under our belts, the more you get on your platform, the more you get under management, the better off you are. Hey, let me grab, this is our lunch. Let me grab this real quick. Alec, can you or take over for a sec, or anybody? Hey there.
So I don't know if I can mute Tyson, but I know one thing for me that we were kind of diving through everything here. I can't take over his screen, but something that I had in mind is this column manager when we're jumping in and out of all of that. Like he was just mentioning the Sharpe ratio and all that stuff. I don't know. Have you guys been able to save something that when you log in, it's the same thing every time? Or do you have to jump in there and take some stuff out and put in what you want when you're getting into the research tab?
Yeah, that's a good question. I was noticing that too when I was in the research and trying to add in a 1 year. It was either 1 year or year to date. And so I changed it in the column settings, but I don't think it saved it. Is that what you're referring to?
Yeah, that would be something that I would like to be able to do. When John Fonash came up, I feel like he said that we kind of have to do it every time. There's no way for us to save it, but I just didn't know if that's been changed or if I had interpreted that wrong. But I know. And then Ryan, I was kind of telling you on the phone last week, and for everyone else on the recording here, I've stopped showing 1 year returns and year to date returns for people when I'm comparing apples to apples because for a couple of reasons. So I think the first is we're trying to make a long-term play for our clients. And so showing someone, hey, 3 years annualized here versus here, we're picking up probably, 1.5% to 2%, and we're dropping fees. But I think it's a slippery slope if we show someone a year-to-date return or a 1 year return, because people are going to be really fixated on that. And it's really easy to kind of get caught with your pants down on our end if we show, hey, year to date in Betterment, you're up 17%, but here you're up year to date 14, they're going to be like, well, that's 4%. So I'm just going to stay with Betterment. And it just makes it a little more difficult to overcome that. So I think the 1 year and year to date is more costly than it is beneficial from a presentation standpoint. So just leaving it at the 3, 5, and 10, I think it makes it way easier to tell that story.
I can speak for the group when I say none of us want you caught with your pants down.
Me neither.
I've got a couple. Hey, we got a couple minutes. So lunch is about 20 minutes out. So we got a couple minutes to wrap up. Any other thoughts or questions?
I just think it would be really helpful as we continue to put money on the platform to if John would be willing. I got a ton out of his first, session. I could only imagine what sitting down with him again after we've been, we've got like, our first dozen accounts on this platform, what that would do again. So I don't know if you'd be up for that.
We could totally do that. So I think what he'd ask of me would be like, hey, why don't you give me a list of like very specific like questions and or things you'd want me to get in? It could be because like there's things we haven't got to yet because we're just still on the onboarding phase, but like I don't know right off the top of my head on like rebalancing accounts, allocation changes, like some of that kind of stuff I just haven't done yet, strategy changes. What I will tell you is if you go to like set up a new account and once you build your models, then all of a sudden what'll happen is when you go through the risk tolerance and get that set for your proposal, like your model that fits that risk tolerance will pop up as like your choice, right? It's just so you click one button, allocation's done, and then you go on with your way. And so anyway, just the little things like that you'll figure out by just getting in there and doing it. So I'm probably in a couple of weeks, I've got some of these original accounts I've done that I haven't put in models. I'm probably going to shift them. And as a fun reminder, I don't even need to call my client. A couple of them I will just to demonstrate some service and touch base because their accounts are up. But I could just make that change without calling my client because I've got limited discretionary authority, which is I've never had so much power in my life. It's pretty exciting. So
So I've done some allocation changes to my personal account, so I know how to do those.
how do you, is it pretty quick and easy?
It is, yeah.
Do you essentially put a service request in and then they do the change?
It's not even a service request. I go in and do it in FMAX.
Okay. Well, maybe we'll
So,
have you cover that sometime.
okay.
Do you do like a new proposal?
Nope.
Okay.
Nope. You just go into settings and you basically look at your investment profile. It shows what you're in, and then you literally just change your percentages and save and activate it.
And how long until it trades have you found?
I have not figured out the turnaround time yet.
Okay.
So I just did one yesterday. So my personal account, when we were brand new to this, I just did a quick 50-50 between the Z model and the American funds. And as I've gotten, my hand around these other, um, the S&P 500 and the growth fund, I got out of that American funds and doing more of like what you just described earlier in this.
Yeah, cool. Yeah, we'll have you maybe show us that at some point. Guys, man, there's just no substitute for just getting in there and doing it, just plowing through, getting accounts open, all that kind of stuff. And that's you might tell that my personal confidence level and conviction level is just incrementally growing week by week by week. And it's a really awesome place to be when you are delivering absolute top shelf, solutions to clients. Um, it's really awesome. And I think we have a total justification to move everything from Goldman And again, I'm not using any language with clients on, hey, my company's sunsetting or ending Betterment or Goldman. I'm just saying, hey, I've been, and maybe I told this to Alec, but if I were in your guys' shoes, here's what I would say. I would attach you to me, and you don't even have to use my name, but you can say, I've been, kind of my team, my office has been working on, building out and piloting and testing this new platform directly with Fidelity Institutional for several years. And it's given me a chance to really tear it apart, see it from the inside out. And we've had it live now for most of this year. And I'm wanting to start moving all my key clients. I don't think you want to say, we've had it live for like a week and I want to throw your money into it. But I also don't think you want to say like a year, because then your client's like, well, why are you waiting a year to call me about it, right? So you come up with a time frame that makes sense for your client and your relationship. But I'd say, I've been, and you don't want a client to feel like they're halfway down your list of priorities either. So you work at that language. But my point is, you can connect yourself to me and our office and our team, my team. A lot of you I know are saying we take a collaborative approach to working with clients. And I'm just constantly like putting credibility out there, just projecting, importance and kind of a level of knowledge and experience and all that. I mean, more and more I'm telling clients, I've been doing this for 25 years, right? And it's like whatever that number is, right? Most of you guys have a few years under you, and but it's just not how you say it. It's not what you say. It's how you say it. It's just looking people right in the eye and saying, this is the absolute cutting edge of money management in our industry. And we built this platform directly with Fidelity Institutional. And by the way, I won't show it to you because it gets into actual client accounts, but I just this morning was, so if you go into eMoney and then you link these FMAX accounts to eMoney, there's some integrations built into that where you can actually be in your client's eMoney portal and click on the account and you can move money, place a trade. You can do all that right in eMoney. It just immediately takes you into an FMAX environment, which is, for what it's worth, is kind of cool. So there's just a lot behind the scenes that has been put together here, and they're constantly looking at ways. I mean, there is a standing meeting between Fidelity people and TFA people, headed up by John. I mean, they just have a working list of like projects, improvements, for everything from tiny little things to big things, and you name it. And yeah, it's going to be really cool. So anyhow, I think we hit it today, guys. So let's keep working. And the last thing I want to say to you is we put a lot of energy, rightfully so, in FMAX, and we're going to keep coming back as I come into new things, and you guys learn things, because I know a lot of us are putting a lot of time and energy here. But let's just not forget that we're not in the hedge fund money management business. We're not just in the let's pick up assets under management business. We're in the let's help people become financially independent business, which includes recruiting people, life insurance, annuity strategies, all of the above. So I don't want to over-index kind of FMAX and get all excited about it and just feel like this is just what we do as a team. Because the truth is, our great power is the diversity of what we're doing for clients and all of that. And I don't want to take my eye off the ball there. So anyways, look out for future trainings coming up here starting next week. I'm going to be in Hilton Head the next couple of days, down with Bill and Tom and kind of a group of Wealth Wave leaders. And so I know they're going to talk about the Dallas event quite a bit. Tom just launched his new headquarters. I don't know if any of you guys have seen that on Facebook. A couple of guys have posted stuff. So they're going to talk about that quite a bit. And there's just a lot of momentum with TFA. There's a lot of momentum with Wealth Wave. And so I look forward to coming back and sharing with you any updates or insights I get there. But regardless of whatever they say or announce or whatever, I'm just going to come back, and I'm just ferociously contacting people right now I'm going to ramp up this fall. My activity level is going to be higher than it's been in a long time in terms of getting with new people and old people and getting them optimized on this platform. So it's going to be a fun close of the year, and I'm excited to do it with you guys. So we'll talk to y'all soon.